apologies for those of you who see me as a source of disappointment this afternoon. As the advertised speaker is the good-looking bloke at the back by the door, Adam Braggs, who was going to tell you about something called Crowdwatch, which is a single login allowing you to keep track of everything that's going on in the equity crowdfunding space. So if you want to see where European pharmaceuticals or American tech companies are coming onto any crowdfunding site, that's your place to go. And I'd encourage you to see him later if that's relevant to your day or indeed evening job. What I'm going to do now is address part of the title of today's event, which is New Solutions to Old Problems, by actually talking about how those new solutions are now connecting with old problems. And I'm going to do that by just going back for a few minutes and reminding us all what the banking sector was like a few years ago, touching on some of the points that Nicola made, but really leading into a discussion of why we're here. I'll make the point in a minute that actually the sector we're in is minuscule compared to traditional financial services, and yet we're all here. And there are events like this happening all over the world every week. So there must be something going on, because we're small and by most measures irrelevant by financial services, and yet we continue to make the headlines, continue to be a source of discussion. So I'm then going to move on and talk about the beginnings of collaboration and cooperation between traditional financial services and the alternative finance space. And then, purely because I was in Washington a month or so ago and had a chance to meet with interesting people there, just briefly talk about whether key regulators and systemic risk observers around the world see this as a new source of systemic risk. So, of course, the story goes something like this, that the banks today are less levered than they were, particularly in Europe, are facing higher capital charges, and are actually run by people who are more risk averse than pre-2008. Point that Nicola made, basically more expensive to lend, and there's less incentive to do so across the bank. We know that story. The bit that plugged the quite significant gap between the world economy's need for credit and the bank's ability to deliver it was called shadow banking. And we all learnt rather rapidly in the lead up to 2008 about things called CDOs and so on. And of course those products, to a certain degree, have completely gone, and in every other respect are a much smaller size than they were. The bottom line is that sector isn't really providing much credit today. And the one that sort of survived is called securitization, the less levered and non-synthetic version of the top right-hand corner there, is coming back, but it's coming back very slowly. It's not really fulfilling the role that it used to. And for those of you who went through 2008 believing securitization is a rude word, make a distinction between traditional securitization, balance sheet securitization for banks, and all the other stuff. Because that traditional form is actually a force for good and should be encouraged, because it's a necessary release valve for banks who have, by definition, very clunky and constrained balance sheets. So, of course, the bit that everyone's all excited about is marketplace lending. Will that fill the gap? Most economies around the world, and even China's today, relies on debt to function. And if debt isn't available, then by definition the economy doesn't function. So something needs to fill the gap left by the disappearance of some of the others on this page. Marketplace lending is clearly one of them. And as we all know, the sector is roughly 10 years old today and has grown exponentially in those 10 years, particularly over the last couple of years, and particularly in China over the last few years. And the map here was intended to illustrate merely how global it is. If your institution is missing, and I know that actually Money & Co is missing, which I apologize. This was merely a graphic representation of that there's a lot going on around the world. But if you look closely, the bit that hasn't got any arrows at all, I think, is Southeast Asia. And again, as I traveled there recently, I thought I'd dwell on that just for a second as an indication of the fact that what we're talking about today is still the tip of the iceberg. Southeast Asia, of course, we all go there on vacation and love it for that, perhaps forgetting that most of the countries there have populations in excess of 100 million. And in the case of Indonesia, 2.5 times that, and generate an increasingly large share of the world's economic production. And estimates suggest that this, as along with other sectors, Peter mentioned Europe being 3 trillion underfunded in the SME space. Well, the guess is that Southeast Asia is 300 billion, and that nearly half of SMEs aren't banked at all. Drill down a little closer and look at a sensible economy, by that I mean well-developed, Singapore, and you can see why marketplace lending has such a significant place. The blobs in the bottom left of the graph show the traditional banking sector, the large blob being the banks, and they, for now, lend to the good companies at relatively low rates. And then there's all the little blobs up in the top right, who is everybody else, essentially the money lenders who charge almost usurious rates to everyone else. And as you can see, there's a huge gap in the middle, and literally in the last 2 years, a couple of peer-to-peer lenders have popped up and exactly filled that space in the middle. And you only have to look at the small chart, if you can read the small print, to see that for a sector that generates well over half of the economy, they are significantly underbanked. And this is true in most countries in the world. SMEs will generate at least half of GDP and yet continually have access to only a fraction of available credit. This graph, of course, is rapidly out of date because we're storming towards the end of 2015, but you can see the last 2 years is what everyone has got excited about in terms of volumes, and we got an analyst recently to try and update those numbers for now. This was a couple of weeks ago, and you can see that China is dominant in the global marketplace lending sector by some measures close to 60 billion. The US is approaching 20 billion. The UK 7 or so, this is dollars, and the EU ex-UK is 1. Now those numbers I'm sure are wrong, depending on where you look, that they vary worryingly, but they are, or probably by now, and certainly by the end of this year, will hit some magic 100 billion number, which I think we all agree, even in this world of billions and trillions, is still quite a big number. And that's why we get excited. Until you put it in the context of economies and the banking sector, and you can see that on the graph, looking across the US, Europe, ex-UK, the UK and China, that the peer-to-peer or marketplace lending sector hardly even get a slice on the bottom there. They are very small, and even if you just look at the SME and consumer lending, so that's, from my perspective, good news, because you've heard some very compelling reasons why this sector genuinely is the wrong way to go. advantage this sector because the analysis being done by third parties will ultimately go full circle and contribute to the underwriting process that Nicola and her colleagues are doing every day. And then there's the other stuff. Marketplace lending uses different data differently. And many of you, I'm sure, have heard the story about the famous slider that helps you decide how much you want to borrow. I've used Zopa as an example, but I think Wonga pioneered this. You think that when you fill in the form as to how much you want to borrow, that the slider is there for your convenience. Why type a number in when you can move a slider with the mouse? The reality is that the platforms are analyzing your behavior. And data has shown that there are two sorts of users. Those who move the slider to the maximum and fill in the form, and those that move it to a number, fill in a bit of the form, move it again and fill in a bit more, and move it because they are thinking about how much they want to borrow. And the data shows that the latter group have a lower default rate than the former. So as a tip, when you're next borrowing online, move the slider. You cannot borrow anonymously. You have to have your cookies turned on. The sites are looking at your browsing history. So if you're online gambling, that's a negative. If you're buying self-help books on economics, that's a positive. And the story goes on. In China, they'll put an app on your phone to follow you. So they're trying to see if you genuinely are a long-distance truck driver or whether you're actually sitting in the bar spending the money you just borrowed, and so on. So you can understand, if you use your imagination, that if you're outside of the constraints, considerable constraints that banks have on the questions they can ask us and how they can profile us, the sky's the limit. And marketplace lending for now is definitely doing different things with different data. If I gave you all a blank sheet of paper and said design a banking sector, it probably wouldn't look anything like the one we have today. And no surprises there. It was invented a long time ago and of course has evolved. Now, it looks like my data differs dramatically from Nicola's in terms of what percentage of the US economy is banked. I'm wondering whether hers was purely SME rather than the whole sector. But there's no doubt that only a fraction of the US economy is banked compared to the UK, Europe, and indeed Asia, where the number, I think, is well north of 80%. But what do banks do? They provide a transformation service. They take your short-dated, low-risk, liquid deposit and turn it into a long-dated, illiquid, risky loan. And there's some uncertainty associated with doing that. And for that, they have capital and lots of rules as to how they can do that. And I think we all agree that in certain situations, there is a need for that, because not all of us in this room have investment needs that are exactly matched by an investment opportunity. So the transformation services that banks provide take depositors' money and turn it into risky stuff. But they don't have to do that all the time. In the 1970s, the mutual fund industry in the US allowed institutional investors to start lending to large corporates directly because it made sense. The people who are managing our pension don't particularly want to put the money in via a bank to lend. Why not allow them to lend directly, which of course is what the bond market does, and increasingly the loan market is an instrument that allows non-banks to invest directly in large corporates. What we're seeing now is this direct lending merely moving down the scale, moving away from sovereigns and large corporates, where it's been for 40 years, into SMEs and consumers. Now, in my opinion, that doesn't mean that every loan will eventually move in that direction. The banking sector will always have that transformation role, but it needn't be as big as it is. And I dug up some research by Benjamin Friedman from Harvard University, the second major bullet on this page, who looked at the US market and noticed in the 1950s, financial services in the US accounted for 3% of salaries and contributed 7% of corporate profits. By the 1980s, look, salaries had doubled, but the contribution to corporate profits was roughly a third. Now, this is the utility that at the end of the day moves money from those who have it to those who need it. And yet that utility was so profitable that it generated a third of economic output. Now, that can't be right. And I think we're going to go back, perhaps not as far as the 50s, but to somewhere in between, where the role of banks as intermediaries is diminished, and rightly so. It shouldn't be a source of profit in its own right. At the end of the day, the banking sector we have today involves multiple layers which are regulated in a non-complementary way so that banks will always be clunky. And what they cannot do is expand and contract with the economic cycle. It is not built that way and unlikely to be changed anytime soon. There used to be a counter-cyclical break. In the days of accrual accounting for banks, banks kept provisions against things they thought were going wrong. And when things actually started going wrong, they took the money out of those provisions. But the banks, to you and I, looked stable through that process. The fact that their provision pool was nearly empty wasn't revealed on a daily basis. It was revealed on a quarterly and annual basis when they revealed their accounts. For reasons that probably made sense at the time, we all live in a mark-to-market world now where everyone has to report how risky they are on a daily basis, which essentially means that that counter-cyclical break that the banks used to provide is no longer there. So what then are the benefits of marketplace lending and banks cooperating? Well, it's already happening. Banks are already providing lines of credit to marketplace lenders because if you're managing a balanced book, it's quite hard to grow both sides of the balance sheet at the same time, so having a line of liquidity from a bank makes sense. Perhaps more exciting, and something which is happening right now, is what I've referred to as the white labeling of marketplace lending sites. Essentially, banks collaborating directly with marketplace lenders to recognize the fact that some of the time, banks might like to separate risk from relationship. Historically, in order to get a relationship from which banks derive fees, they had to lend. And as Nicola has illustrated, lending is even less profitable than it used to be, particularly to SMEs, where the cost of approving an SME loan is about the same as the cost of approving a medium-sized loan. Whether it's 100,000 or a million, the work done is similar. So it's uneconomic, but it has to be done to get the relationship in order to do the fee-based business. The banks would love to partner with marketplace lending to let the non-bank sector take the loan, allowing the bank to continue to offer the services they offer. And that's starting to happen. As part of the products we're developing at Crowdnetic, I've spent the last 6 months meeting with approximately 50 banks around the world, discussing what their views are on marketplace lending. Are you going to collaborate, crush, or just compete? And collaboration is the story that has come out literally 100% of the time. Banks recognize that this makes sense, and why wouldn't they? They're turning away a high percentage of their origination right now because either they can't lend or they won't lend, or the people tasked with lending just can't be bothered. The opportunity to deal with a growing problem in the marketplace lending sector, whereby there's a surplus of institutional money now and not enough origination, would be to partner the two and move some of the surplus origination from the banking sector to the surplus liquidity in the marketplace lending sector. Where does that eventually lead? To active credit portfolio management. Now, the graph here shows the typical risk portfolio of a bank. Every bank would like to have a smooth risk surface. The reality is more of a Himalayan approach, lots of spikes, representing exposures to a bank's best customers. Now, in the old days, credit default swaps took all the spikes off, and securitization took a homogeneous slice of the portfolio off the bottom, allowing the whole mountain to flatten and be reduced. Now, credit default swaps don't work for small companies. Well, actually, right now they don't work, but they definitely don't work for small companies. And securitization of consumer and SMEs is still very small and hard to do, partly because SMEs, by definition, are not your usual company. The most unusual companies you'll ever meet are small ones. They've just started. They haven't yet worked out what they're going to be. Part of the reason why they're so hard to risk assess is they don't fit into some neat category. If they don't fit into a neat category, they're very hard to securitize. If banks can partner with marketplace lenders, they can use that as mini securitization. They can have a pipe through which they push stuff on a daily, weekly, or monthly basis. Unlike securitization, which has to be done in chunks of hundreds or even billions of dollars, it's costly, and it's probably only done once a year or so, and normally requires a rating from rating agencies who got burnt badly 10 years ago and are somewhat reluctant to rate pools of consumer and SME debt. We haven't yet seen evolution to stage 3 on this slide, but I suspect it'll come. I don't know, handouts are being made available. I'm not expecting you to read all of this, but there are lots of announcements that have come out. I'm sure you've read about them. We're already seeing this partnership happening. Take a quick look. It's happening in New Zealand, and it's happening in North America and everywhere in between. So is this then a new source of systemic risk? I reproduced the graphic produced by the Fed in 2009, which if you printed would require 4 pieces of A1 paper. It was showing the interconnectivity of what used to be called shadow banking. It was complex, it was hard to understand, but it did provide 50% of the West's credit needs in 2007. So we all choose to hate it and despise it, but it provided a function, and the removal of it has created a problem. My own graphic, not to be read too closely because it's merely a graphic, shows that the interconnectivity of marketplace lending is growing, but it's a lot simpler. This is all very transparent. We are surrounded by social media watching us and commenting on us. It's highly unlikely that anything too nefarious could happen without the crowd figuring it out. And I think that the combination of the fact the majority of the market is fully funded and it's transparent spells a very positive story. I think the question remains as to how the sector will perform when interest rates go up. The assumption is default rates will go up and some institutional money will go back to high yield, which will reprice to the levels discussed earlier of that 9.1% number, which of course used to be the domain of high yield, which today sits where high grade is, which today sits where governments are, which today are trading at 0 or negative. That will change, probably not this year or next, but it will change. And when it does, marketplace lending will suffer, but I think it'll only result in a rebalancing, and we probably need that. So this sector has come about because of a confluence of financial and economic events. And the mention earlier of financial technology, yeah, that's quite relevant. But actually, in my travels, most of what I'm talking about with banks is concepts. The assumption is that technology works. Nicola reminded us of why it's important. But for the change that I'm talking about, it's going to be done conceptually at the board level. Don't think technology will really create the change that I'm hoping for. I think the numbers are small, we've mentioned that, but with few regulatory hurdles today, there's really no limit on growth, and I think we'll see it grow very quickly. And remember, this is more than just a better way of doing something. I think the banks are unlikely to stand back and watch. We're seeing evidence of collaboration happening already, and banks are very mindful of the fact that they are being scrutinized by a fussy and increasingly sophisticated crowd. I think we can expect some more innovation, but also I think we can expect some consolidation. The point was made earlier about how all of these sectors today are in neat little silos or verticals. For an SME, that's tricky, because often when they need financing, they don't know exactly what they want. They go in saying, we need some funding for this new piece of business, but do they want factoring, invoice discounting, a term loan, or something else? I think we'll see some consolidation so that the SME lenders of today will perhaps offer a broader range of services than they currently do. At the end of the day, the really important point is this isn't just moving money from one lending portal to another. This is genuinely creating a multiplier effect, meaning because of marketplace lending, people who previously couldn't borrow can. By people, I mean small companies. If small companies are borrowing to grow, to hire more people, that has a multiplier effect on the economy. And back to Peter's point earlier, that is why policymakers should be sitting up and taking note. And this is genuinely bringing more credit to the system. And at a time when the outlook globally is gloomy, we need some change to allow the SME sector to contribute in the way it would like to. I have no idea how we are on timing. Do we have even time for questions? Keyword there may have been break, but any questions now, or I'm available in the break? Yes, sir. Yes.